All right. How can I defer or completely avoid the capital gains tax? Don't make any money. Don't sell it. I'm just kidding. All right. Is the 250,000? This is bad start. This is section 105, by the way. So, or not 105. It's 121. 121. Yeah. The $250,000, $500,000 exemption or exception or exclusion technically is what it is to capital gains only. The reason that's important is because some people rent their houses before they live in them. So only the capital gains are excluded. Yes, that's still alive and well. It's $500,000 for married filing jointly, and you have to have ownership and lived in it 2 of the last 5 years. So if you're getting a divorce, this becomes very important because you want to make sure if you want that $500,000, you both got to own it,
right,
before it's sold. So you don't want to make sure you don't take your name off it and then lose that. Are there sale transfers to permanently defer or eliminate gain on tax? So you can defer it under a 1031 exchange, where, and this is only for investment properties. So this is not for your home. So the 121 exclusion is for a property you lived in as your primary residence 2 of the last 5 years before you sell it. So technically, you could have a home that qualifies for 121 and a 1031 exchange. 1031 exchange is I exchange real estate for more real estate that's investment real estate. So it could be land, mobile park, condos, a bunch of single families, apartments, and I could exchange them for any of those. It doesn't have to be like the same thing. It doesn't have to be an apartment for an apartment. It could be an apartment for 20 single family residences, or 20 single family residences for a mobile home park. It could be 20 condos for a farmland. Like it doesn't have to be the identical type of real estate. It just has to be real estate.
Right. It's very loosely defined.
Yeah, and that's just deferral, meaning that you roll the what would it be? The basis forward. So if you've depreciated the heck out of a piece of property and you buy a new property, you're just rolling that small amount of whatever's left into the new property, with the idea that if you sell at that point, that you'd have a taxable event and the IRS makes its money up. If you die and you hold that property, the basis steps up to the fair market value and nobody pays tax on it. Yay! So don't sell your property before you die, right?
Now, you're a little more read up on this, but I haven't seen anything talking about opportunity zones.
Mm-hmm.
I haven't seen anything that says you can't take the gain from your house outside of that 250 or 500,000.
Correct.
And use that for an opportunity zone investment.
All right. So what Jeff is talking about is something called qualified opportunity zones that were born out of the 2017 Tax Cuts and Jobs Act, or Tax Cuts and Jobs Act. Tax Cut and
Tax Cuts and Jobs Act.
Plurals. Tax Cuts and whatever. Peeper, pickle, pepper. So the qualified opportunity zones are these economic areas that the states have designated, and all states have designated some, in the Treasury's approved, I believe it was the Treasury, that approves them and says, all right, these are economic zones. If you invest in those, then you get some weird benefits. The first one is I have to invest in an opportunity fund that owns 90% opportunity zone property. This isn't just real estate. This is any property. Real estate does qualify if you improve it, and the improvement is equal to doubling the value of the improvement on the property. So I won't get into all this craziness. I've done podcasts on it. You can go look out there. But you're deferring capital gains, period, not just on real estate. You could sell Bitcoin. You could have sold stock in Disney, whatever.
Sold your kids.
Sold you? No, you're not allowed to. Don't sell your kids. Rent? No. Rent them out. No, but you have your capital gains. It doesn't matter what it's from, and you can take that gain and you defer it for up to what right now is 7 years. Right. It used to be you had to pay tax at a minimum. At last year was 8 years, but now it's 7's the magic number, because you are lowering the amount of tax on it by you exclude 10% of the gain and 15% of the gain. I probably misstated that. The way they look at it is they actually give you a zero basis and increase it by 10 and 15%, or a total of 15%. In English, what this means is if you had $100,000 of gain in 7 years, you're going to recognize 85% of that. So you're going to recognize 85,000. Reason this is important is because that's the only tax you'll pay on that property. If you hold it for at least 10 years, you don't have to pay capital gains on that property. So let's say I sell some Bitcoin for $1 million. I buy into a fund and I can create my own. It could be a partnership or a corporation. So it could be an LLC tax as a partnership or a corporation. And I buy into something that has opportunity zone property and I qualify. So let's say I take my $1 million and I buy some property and I fix it up. And it's over the years, it grows to $4 million. So how much did I spend on it? $1 million. How much is it worth now? $4 million. I will have to pay tax on that $1 million investment. I'm going to have to pay tax on a portion of it, whatever portion was my capital gains. So let's say that the full $1 million was all capital gains. Then I would pay tax on $850,000 in year 7, and I would never pay tax on anything else. So I sell it 20 years later, it's worth $4 million. I pay 0 tax at that point. In year 7, I paid tax on the 850 only. So that thing's appreciated $3 million and I pay 0 capital gains. That's the only way I know where you can completely avoid it.
And when we're paying this capital, at the 7-year mark, the 85%, that's at the capital gains rate also, correct?
Yeah, that's capital gains. You're just deferring the capital gains. And on year 5, you get to say, hey, 10% is my new basis. So if you have $1 million, your new basis is 100,000. So you only pay tax on 900,000. The next 2 years later, you get another 5% for a total of 15%. If this is making your head hurt, trust me, it should. It's not the easiest, but once you say it 20 times, it becomes easier. So hopefully you guys are getting it.